Okay, so hello, good morning, everyone. This is a preview of the FOMC meeting for today. So I'm recording this on Wednesday, December the 10th, about 11 o'clock in the morning, so a few hours before the meeting. Let's just see exactly, try and get a good sense of what's actually priced in to the market. So if we go to the CME FedWatch tool, which is a sort of a aggregate of the probabilities, we can see that as we speak, about 90% is charged in for one cut. So the current target is 375 to 400. So let's call it 3.875 is the mid-range target. So 3.875. So the first thing to say that a pause would be a massive sort of hawkish surprise. As we could see, only 10%, the market is expecting that with a 10% probability. So that would be a huge surprise. Obviously, the first thing at 2 o'clock, when we get the statement and the decision, if they were to pause, that would be a terrible shock. We could expect to see gold down. We could expect to see the equities obviously coming off. Bonds, the short end of the curve would quite like that. And probably the long end of the curve would like that a lot. That would signal that the Fed is more aggressive about fighting inflation, and the US dollar would go up. But again, very small probability. So let's assume that's not going to happen. So therefore, what we do have priced in, as I say, is a 90% chance of a cut. And if we actually just see how that's changed a little bit, we can see that over the last month, which is basically this sort of pale blue here, you can see that that was at 62%. So essentially what's happened is that the market has come around to this idea that the Fed will cut. They were a little bit more skeptical a month ago. But where we're starting to see some sort of changes is really sort of further out into 2026. And there's been a little bit of a sort of a discourse gathering momentum globally. We saw, for example, the Bank of Canada earlier today sort of do a pause. We saw that the RBA did a pause. So we're seeing a few sort of central banks around the world, the ECB also potentially talking about hiking. So the general sort of sense is that maybe we don't need to be doing any more cuts in 2026, and potentially even if the economies continue to be robust and inflation remains sticky, maybe even a hike also at various central banks around the world. Having said that, the Fed is still very much in some kind of cutting cycle. And let's just see what's sort of priced in. So if we just go to the probabilities, we can see here that really going out towards, let's say, the end of 2026, so we'll go to 2026 here, you can see that the highest probability at 31% in terms of the distribution, this is where we are now, is for 1, 2, 3 cuts. So one now in December, and then a further 2 cuts next year. And you can see that if you get the aggregated probabilities, if we go to the end of 2026 here, you can see indeed that, 1, 2, 3 cuts does get an aggregate probability of 95%. So that's what the market is pricing in. And that's interesting because just in terms of the dollar, we're really getting a sense that, the rest of the world is sort of definitely on pause and maybe even considering hikes. But the Fed, at least according to the market at this point in time, is still expecting, another sort of accumulative total of 3 cuts. And now I just want to show you just a little bit of a graphic here, just to put that into some kind of context here. If we look at that here, this is just from all the different the central banks around the world. And this is net pricing by the end of 2026. So this year, of course, we've got the Fed cutting 25 basis points. But if you go out to 2026, the red here means a cut, negative value. You can see that the FOMC, it's actually sort of in quite a lot of contrast. I mean, you have Norway here, but essentially, and the BOE, but essentially a lot of the other central banks, the market's already pricing in, between, 1 and even up to 2 hikes. You look at the BOJ, 1.5 hikes. You see New Zealand, 2 hikes. In Australia and Canada. So this is causing some kind of, market-based pricing of policy divergence. That's the interesting one to look at here. Now, let's also just see what this sort of means. I just want to look at, sort of the general sense of what the bond market is telling us. So let's go to... Where will that be? That would be here. Sorry, I just got a lot of things on my screen here. So let's just actually have a look at some of these. So we see here the effective Fed funds rate, is approximately at the target of the middle. So let's call it about 3.89, but let's say 3.875. And what we've really seen over the last few weeks is a little bit more of a sort of skepticism that the Fed will cut aggressively in 2026. And we all know that there's been quite a lot of talk about potentially new, very dovish sort of Fed chair appointed by Powell, someone maybe like Kevin Hassett. But, recently, it's like, oh, they're still interviewing people, and the bond market, the long end bond market, it has essentially communicated through the following. If you look at, let's say, the bond yields here, you can look at here and see that like the 30-year yield, I mean, today it's down a little bit, but over the last couple of weeks, the 30-year bond yield's gone up, the 10-year yield's gone up a lot, and even something, the one's gone up a lot is the 5-year yield. And essentially what that's saying two things. It's saying that inflation remains potentially a little bit sticky, and also secondly, it's saying that the bond market believes that the U.S. economy going into 2026 will not necessarily fall off a cliff, and then in some shape or form, maybe an overly dovish Fed, a relatively robust economy, and sticky inflation and too much bond issuance. Essentially, the bond market is calling for higher yields from the belly of the curve outwards. And it's interesting that the 5-year, if you look at something like the 2s to 5 spread, so this is the 5-year yield subtract the 2-year yield, you can see that that's had a pretty nasty bear steepening here over the last 5 or 6 days, gone up to a spread of from 10 basis points to 17 basis points or so. So that's gone up quite a lot, and that's indicating confidence that, as I say, the U.S. Economy will remain strong. Maybe inflation is not going away, and again, there's that sort of policy mistake error. Potentially, if the Fed is too dovish going into 2026 under a new chair of cutting too much into a relatively robust economy. So that's kind of the general context. And just finally, just have a quick look. If we look at some sort of short-term interest rates here, if we look at, let's say, the implied yields, just see what's happening here. You can see here, this is a daily chart. You can see that, the pricing essentially for the last few days for the December contract, for the SOFRs, the 3-month contract hasn't really changed much. But as soon as you start going out to, let's say, March, you can see that that's pushed up a few basis points. Then into June, you see even more. And then as soon as you start going up to like September of 2026, so, 9, 10 months into the future, and then the December 2026 contract, you can see that really these yields have pushed up a lot higher. So we've got sort of a bear steepener as well happening in the SOFR, the 3-month contracts, essentially saying that the market has dialed back the dovish outlook for the Fed. So that's the situation. Now, let's just also talk about what's expected as well. So the market is pricing in, as we saw, approximately 2 more cuts in 2026. But if we actually start to have a look at what the Fed themselves have been saying, so keep in mind, we have 2 things here. We have what the market is pricing, which is still relatively dovish. So including, let's assume they cut today 25 basis points, we have another 25 basis points. So that's a totality of 75 basis points cut. But the interesting thing is that the market is actually still, despite the recent hawkish tightening, the market is still actually more dovish than the Fed itself. So if we now look at the summary of economic projections, which we will be getting today, we didn't get it last meeting, we get it every 2 meetings, of course. You can see here, this is the key number here to look out for, is the Fed funds rate is 3.4 was the projection at the end of 2026. Now, the point I'm trying to make here, let's just look at the maths here. So let's just take this slowly. So the effective Fed funds rate, well, the mid-range is 3.875. 3.875. If they cut 25 basis points today, which is highly expected, that would get them down to 3.625. So 3.625, which is essentially, what they're projecting here at the end of 2025. So this 3.4 is a rounded number of one further cut, which is to say 3.625 going down to 3.375. Which is then rounded up to 3.4. Okay, so put that in simple terms, this 3.4 is essentially a rounded number of 3.375. So the Fed themselves, the last time in the summary of economic projection, 2 meetings ago, were projecting 1 cut now in December and one cut in 2024. So the question is, what are they going to say? And then, as you see, going into 2027, one further cut, and then the longer term, more or less keeping it there at 3. So what's first of all going to be the absolutely critical thing to look out for is, do they communicate a more hawkish stance for 2026? Now, again, keep in mind that the market basically has this number at 3.1, whereas the Fed themselves are saying 3.4. So what would be a huge, huge dovish surprise, absolutely, I think would be extraordinary, would be if this number went to 3.1, because that would be the Fed becoming even more dovish and saying, no, no, we are going to be cutting more. Now, under a new Fed chair in the middle of 2026, who knows what's going to happen? If the economy collapses, if the unemployment rate skyrockets to 5%, for sure the Fed could be more aggressive. So, the consensus today is to keep that there, which again is still, I repeat, more hawkish than what the market is pricing. So therefore, the first thing to keep in mind, guys, is this idea that for a dovish surprise, it would be very, very difficult because the market is still one full cut more dovishly priced than the Fed. You see what I'm trying to say here? Is that it's not as though the Fed is dovish and the market is skeptical. It's like the Fed is more hawkish than the market. So a dovish surprise for the market would be very, very difficult. It's a very high bar. So therefore, that means something like the SOFR contracts or the ZT, the 2-year bond, would be very difficult for that to rally today unless they do something pretty crazy. So let's just look and have a look and see some of the numbers, how the voting could go today as well. So let's first of all just do a little bit of an overview. So keep in mind here we have rotating presidents who can vote. So let's forget, in a sense, the 2026 and 2027 voters. Let's just look at the 2025. So we see here the hawks. We're expecting today, let's think about the dissenters. We could have Schmidt, a kind of he's a bit of a hawk from Kansas City, so he could be a dissenter. But we also have potentially, who knows, maybe in the future we have some others, but maybe this could be a hawkish dissenter today voting for no cut, which could be Schmidt. On the other hand, we have some of the doves. We're expecting that someone like Miran, who's was Trump's appointee, is he going to go for minus 50 basis points? And again, this is where it gets kind of interesting, because even Miran has been saying recently, well, if they were to vote for 25, he may agree to that. And so this is getting into the political thing here, that we know that this, the increasing, well, sort of sticky inflation and the sort of ever more sort of talked about and discussed affordability crisis is becoming a political problem potentially for Trump and the Trump administration, especially as we go into 2026 and the midterm elections at the end, November of 2026. And it could be that even some of, the Trump's appointees like Stephen Miran, and others sort of in his cabinet are sort of going, okay, maybe we don't actually need to be cutting, or we shouldn't cut too aggressively, because that could really, okay, the good thing is that could maybe turbocharge the economy, but it could also bring with it some kind of increased inflation, which is a political problem. And so therefore, it's interesting today that maybe Miran maybe will not dissent if they cut 25, and will not dissent with a 50 basis point and say, no, no, I wanted 50. So so one of the dangers here today, or one of the interesting things, is that the doves may actually become a bit more centrist. So we know that the hawks, there may be some who say, hey, we don't really think we need to be cutting. But what actually could be quite interesting and a little bit hawkish is actually if the extreme doves become a little more centrist. You see what I'm trying to say here? So maybe there won't be dissenters like sort of Waller and Bowman. These people are quite dovish. But let's say, for example, there are no dovish dissenters. That would indicate actually that extreme dovishness is coming back towards the center. We know the hawks are still there and the centrists. So grosso modo, all things considered, that would be a slightly hawkish tilt, which risk assets would probably not like. The front end of the curve would not like that. Gold would not like that. And the dollar would like that. So that's an interesting one in terms of the dissension. So if we don't get any dovish dissensions, that would be obviously a bit of a sort of a hawkish signal. So let's just see as well what's, some of the banks, what's consensus, what everyone thinks today. So if we're looking again for the 26 dot, which we looked at, again, this is signaling, this is basically signaling just 3.375 would be one cut. So you can see that a lot of the banks here have 3.375. Okay, signaling one cut. That's kind of consensus. But you see here, we've got the BOA. They're a little bit more dovish. They're saying that the Fed may actually become a little more dovish. So that would be dovish. You want to first of all look at that 3.125. That would be out of consensus and dovish. On the other hand, we have BNP, who are coming in a little hawkish and saying that that would be definitely a hawkish signal. So keep in mind, very important on the summary of economic projections, the 2026 number, which we'll just go back to just to refresh our memories. Keep in mind that if this number for 2026 were to go to 3.1, obviously that would be a very big dovish surprise. You want to be probably buying equities, the bonds in general, selling the US dollar on that one there, and probably gold would like that as well. Now, of course, if it goes up to 3.6, which again is out of consensus, that would be the opposite. That would be quite hawkish. So let's also keep an eye on whether they, play around and sort of, make this potentially change the 2027. Again, they could maybe make this more dovish, make that more hawkish, or they could keep this the same, but maybe the longer run, they could push that up to 3.1 just symbolically to say, hey guys, longer term, we're not thinking of sort of being overly dovish. So that's the most important thing to be looking out for today. Now, of course, the other things we want to see what the Fed thinks about the overall economic performance. So the GDP currently for 2026 at 1.8, unemployment rate 4.4. And then let's go for the core inflation. What do they think? So what I want to share with you is just again, just get a sense of the consensus of a lot of the research houses and the banks. We've got a few numbers here. Let's have a quick look at them here. So again, for the economic projections for the GDP, currently at 1.8. So it's interesting here. Various banks have it a little bit higher. Obviously, if they have it higher, if that comes in higher, let's say, 2 or something like that, that would indicate a Fed which believes that the economy is robust and that, maybe they don't need to be cutting as aggressively or they don't need to be as dovish. There's a few 1.9. So no one here is really sort of forecasting a much weaker number. So 1.8 was the last SEP. And as you can see here, there's not really any forecast coming in for a lower number. So a lower number, a weakening economy would be out of consensus and would be dovish. Moving on to some of the other numbers, let's look at the unemployment number. Now, we know the Fed is very obsessed by this. There's been a lack of data. We know that a lot of the employment metrics, we're starting to get some stuff. We saw the employment cost index this morning go down a little bit. That's a bit deflationary. Generally, what seems to be happening is that the labor market seems to be sort of flat or softening. Wage pressures seem to be going down a little bit. It looks as though employers are starting to get a little bit more power because people are quitting their job less. So it does seem to be, yes, there's a lot of people being deported. Yes, there are less immigrants. So the supply of new of labor is diminished, but there's certainly not a lot of hiring. So it looks as though it's a flatlining, slightly weakening labor market with declining prices, or sorry, I should say declining wage pressure, which is deflationary, which is good for the Fed. But in terms of the unemployment rate, the Fed themselves had it the last time at 4.4. Again, what a lot of the banks, just a cross section here, there are a lot of people saying is essentially going to be unchanged. And to be honest, it's going to be difficult to see the Fed really changing that in the absence of a lot of data. Keep in mind, because of the government shutdown, the Fed essentially was unable to get, a lot of data. On the 16th, we actually get the more updated NFP. So that could actually be a bit more important. So let's keep an eye on that one number. Of course, the core PCE, this is an interesting one. Last time the Fed projected that at 2.6. It does seem as though inflation is not getting out of control and ripping higher. On the other hand, it doesn't seem to be collapsing in any sense. Now, as I just mentioned, there are certain little indicators here, like the employment cost index ticking down a little bit, wage pressures maybe going down a little bit, but still there is a little bit of follow through from tariffs, and service inflation still seems to be relatively sticky. So the Fed, does seem to be stuck in this mid twos to late twos kind of area. So let's see. Again, a lot of the banks here are calling for no change, essentially. If the Fed were to revise that higher, of course, that would be hawkish, 2.7, 2.8. On the other hand, if they were to cut that, obviously 2.4, 2.5, something like that, that would be dovish. And again, we have to see a lot of these projections and a lot of these numbers in the context of the dot, the median dot for 2026. It would be very strange, for example, if the Fed had, if they cut the dot, down to 3.1, but they, for example, raised the GDP, lowered the unemployment rate, and raised in inflation. That would be completely illogical and antithetical to what they're trying to achieve. So let's keep an eye on all of those numbers there. And again, just a quick refresher: all of those numbers are found obviously on the SEP projection. So is these numbers here. So we need to be looking at all of these numbers. But again, the first thing is going to be looking at that one. So the other thing which is going to be very important to look out for is maybe the statement. Let's just have a quick look at the statement. Now, in terms of January, if we assume that the Fed cuts today, what's going to happen in the press conference at 2:30? Obviously, Powell is going to be asked about, a January meeting, March meeting going forward. Are they going to cut more? If the SEP is saying, just one more cut, but the market is pricing in two cuts, the role of inflation, the tariffs, is the Fed sort of done? Is it one and done? Are they paused? Is that it? Are they going to be more like other central banks around the world, sort of on an extended pause? Is Jerome Powell and the Fed going to go against market pricing for another two cuts? We shall see what he has to say. But one way they may want to signal a pause in January, let's say in the press conference. This is the last statement, as you can see here, October the 29th. Of course, this is released at 2 p.m. In the past, if they've gone from sort of a cutting cycle to a pause, they've often used the phrase, and I've got it here, something like the extent and timing of additional rate adjustments could be introduced. So if they introduce something like that, to say that the extent, like the magnitude, and timing of additional rate adjustments, that could be code to basically say, hey guys, hey market, the extent, so the magnitude we don't know, and the timing we don't know. If they use, the extent and the timing, that's a strong indication to the market that, question mark, maybe January is a pause. Now that doesn't mean they're not going to cut, let's say, for example, in March and maybe in June, further cuts going into 2026. But maybe this idea of cutting at every meeting would be signaled by that. So let's keep an eye on that. And obviously, of course, as always, we need to sort of see what they say in the first paragraph here about economic activity. Last time they said it's been expanding. Let's see what they see about jobs. Let's see what they say about inflation. So really, economic activity, jobs, and inflation, very key to have a quick look at that in the first paragraph of the statement. Now, the other thing which is going to be quite important in terms of market reaction, there's been a lot of chatter that there's that the Fed is starting to become a little bit worried about liquidity in the repo market and things like that. Now, keep in mind that on December the 1st, the Fed officially sort of stopped the roll-off of the balance sheet of bonds, repurchases and whatnot. So technically, they have stopped officially a quantitative tightening. And there's been a lot of let's say market commentary analysis saying that the Fed, because they are a little bit worried, potentially about liquidity in the funding markets, they may start they may announce the beginning of purchases of short-term treasury bills just to boost liquidity, just to put more liquidity into the funding market. Now, the question is that expected? It wouldn't be entirely unexpected. I've seen estimates, a lot of people saying, no, they're not going to do that. That would be too dovish. That would be pumping unnecessary liquidity in the system. Other people said, absolutely, they may go up to even $45 billion per month of liquidity, short-term bill issuance. So the question is, how would the market react? I would say that, if they don't do anything, that would be a slight disappointment, slightly on the hawkish side. Anything, I would say, greater than 5 to 10 billion, of additional short-term treasury bill purchases. That is actually, now you could argue that it's a bit of QE, or it's not necessarily or not technically quantitative easing. But the reality is, if they're going to start pumping in 5, 10, 15, not even talking about 45 billion, which is a number I've heard, and a lot of commentators are saying, if they're starting to pump in 10, 20, 30, 40 billion dollars per month, even if that at the margin is not a huge amount of money, symbolically the narrative is really extra liquidity flooding into the system. And I personally think that would be extremely dovish for risk assets. I think the stock market would love that. I think crypto, BTC, Solana, everything would love that. And gold, I think, would love that. Now the dollar would hate it. So that's also going to be very important. If that may be mentioned in the statement, or there could be like a technical annex, we have to really keep focused on any additional liquidity through the purchase of short-term treasury bills. And if you hear nothing, you can say that the market may be a little disappointed. But if you hear a number of 10, 15, 20, 25 billion, and not 30 or 40, 50 billion, that would be dovish. And I think the market would love that. So in terms of other stuff, obviously, we then need to look at or listen to the press conference, see what Powell has to say. Although, as I say, just going back to consensus, really everyone is expecting, the market is expecting a cut. So really the issue here is really that 26 dot. Is that going to have any surprises? And also the longer term dots. How do they see the unemployment situation? And also that question of short-term liquidity. In terms of market reaction, as I say, if we look at some of the key markets, we can see that let me just bring up a few charts here. We can see that, let me just go back to some charts here. We can see that the stock market, has just been trading around highs here. As I say, any extra liquidity, I'm sure the equities will rip to new highs up to 7,000 without too many problems. If the S&P dot for 2026 it continues to say that there will be another cut, and obviously if it's lower, the stock market is going to love that. What could get the stock market's attention in a negative way could be no extra liquidity, no extra buying of treasury bills, and of course, if the dots in any shape or form are revised upwards, indicating less cuts. That would be a problem. And of course, we have to look at the individual dot plot and see where they're going as well, just looking at the individual members, because of course every member gets their dots. So it's going to be interesting to see that dispersion as well. Now, in terms of the short-term bond markets, we've seen, for example, if we look at something like ZT, again, looking at the price here, not the yield, we can see that the price has gone down. So in a certain sense, what people could talking about a hawkish cut, that I would say is priced in. So, maybe this could be some upside, if Powell sounds relatively dovish, and if those dots, surprise, went lower, that would be a, pretty nice dovish surprise. So I think the front end would like that, although maybe the long end wouldn't like it quite as much, because that would indicate a less aggressive stance towards fighting inflation, which the long end bonds don't like. So we could really see there a bit of a steepener here, a bull steepener, if they're dovish, and definitely the front end yields would enjoy that more. In terms of the dollar, fairly simple. If we look at the dollar here, you can see it's just been in a holding range for the last few days or so. It has come off over the last 2 or 3 weeks, as we all know. Again, the dollar would not like too much extra liquidity. It doesn't want any dovishness. What the dollar wants to hear is, sort of a continuing vigilance about fighting inflation, and maybe a little less liquidity. That would be potentially supportive for the dollar. Okay, guys, so I'll leave it there. I think that's covered everything I wanted to say. So good luck with that. And let's see how it all pans out at 2 p.m. and 2:30 p.m. this afternoon, and hope that was useful. We'll be back tomorrow with another macro snapshot. Thank you.